Okay, here we are. Good morning, everyone in TV land. Welcome to the August 19th, 2026 meeting of the Trustees of Trust Funds. I note that all the trustees are present, therefore we have a quorum, and I will officially call the meeting to order. And as the first item of business, invite a motion to approve the minutes of our July 15 meeting. There's an error on our agenda. That was my mistake.
Oh.
Do I hear such a motion?
I move the approval of the minutes of the July 15th meeting.
Is there a second to that?
Second that motion.
Any comments, corrections, or deletions? Hearing none, I'll call the question. All in favor indicate by saying aye.
Aye.
The chair votes aye. All right, next item is the Kohlhaas, the final agreement for the Kohlhaas Building Trades and Vocational Scholarship Fund. You recall that we voted, we approved the terms of this document at our last meeting. Since then, it has now been approved by the school board earlier this month and been signed by Mr. Kohlhaas and the superintendent of schools, so it's ready for our signature. And I believe that Judy has the original of this document.
I move we accept the final document
And execute.
and execute.
Do I hear a second to that?
Thank you, Peter, and I second it, yes.
All in favor indicate by saying aye.
Aye.
And the chair votes aye.
Today is the 19th.
19.
Thank you. Thank you.
Judy, just curiously, why is there separate sheets for each signature page?
No clue, I didn't assign it, so.
We're so used to having one of our members not around for part of the year.
And I think that could have been it, so.
All right, next item on the agenda is the request for disbursement from the Cable TV and Public Access Channel Fund. And as I mentioned in the email in which I distributed these materials, because they came in, specifically the request from the city manager came in after our Friday deadline. Under our policy, we don't look at items unless we waive that deadline. And I would entertain a motion from somebody, preferably on my right, who would say that.
I'll move we waive for this instance our policy that items must be received by Friday before the meeting.
Okay, do I hear a second to that?
Second.
Would you like to speak to your motion?
No, I just wish that we get back to this because, for instance, I printed this morning, Tom, 18 pages from you. And, you know, if we're gonna do our job, we need to have a packet done with no exceptions. And if the people can't do that, then maybe we need to say, well, you gotta have it to us till Wednesday before the meeting. You know? We need to stay with our policy.
Agreed. I will call the question on the motion. All in favor indicate by saying aye.
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 And the chair votes aye. All right, so next is the request itself. Again, briefly, this is the fund that was established through the city's contract with the Continental Cablevision, or whatever it's now called. And it's a fund that results from monies that are received by the city from the cable company, but those funds have been decreasing over several years and have now reached the point where the city's predicting that they will not receive any more of those funds. And so I think the city anticipates this will be a 2-year, 2-step process. If we vote to approve this today, we will disperse all remaining funds in this to the public television station. And thereafter, at some point after next year, we will be asked to close out the fund because it will be dormant. So today's motion is to approve the disbursement of the final sum of money, which is, as of the beginning of this month, $8,638.87. And I would entertain a motion to that effect.
So move.
Do I hear a second?
Second.
Any further discussion?
I do actually, Tom.
Sure.
And are there any entities that rely on those funds now? Is there going to be a budget shortfall as a result of this fund? I know it's been slowly going down over time, but.
Yeah. There's only one entity, and that's the public television.
And now that they've moved out of the meeting house, a lot of their expenses have been changed to wherever they moved to, and
I think they're on Middle Street or something.
We're
yeah,
on Middle Street.
The answer is that anticipating this has been coming this day, the city has advised the public television group that they need to start doing, and they're a nonprofit, they need to start doing their own fundraising like most nonprofits. So how long they'll be around will largely be a function of how successful they are at doing that.
Thank you. That's helpful. Thank you.
All right, I will call the question. All in favor indicate by saying aye.
aye.
The chair votes aye. All right, next item on the agenda is just an informational item that I thought you should see. So you'll recall that back in June and July, June, we were asked by the city to give our opinion on whether the below market
You
rate.
skipped one, Tom,
I did, which one was that?
the bench.
Susan
You need to-
Warren Thorson.
But I don't.
It was tabled, but.
Oh, I'm sorry, okay, yeah, the item 4 on the agenda is actually withdrawn.
Yeah.
I believe the council did vote on this, but there's no requirement for either depositing monies with us or for us to withdraw monies on this. This is under the arrangement proposed by the Park Committee. The city has already approved hiring somebody to create this memorial bench. There is a donor for the first $10,000 out of the $20,000 that's going to be allocated to this. That money is going to go directly from the donor to the artist, and so there's nothing for us to do today. At some point, we will start receiving checks as we had on the Nebby sculpture until the remaining $10,000 has been raised. And then at the city council meeting last Monday night, they also approved use of some of the art-related funds in the CIP for any overage that isn't covered by the private fundraising. But for purposes today, there's no action is necessary.
Okay, thank you.
Questions on that? Or?
For me.
And then on the next one, as I said, on the below market rate housing trust, the city had asked our opinion back in June on whether the funds in that account could be used to cover the cost of a study for artist
Housing.
work, live studio housing. And we made that analysis at our July meeting with some specific conditions, particularly related to the housing. It had to be studio housing for artists whose income fell below, the household income fell below the average or the mean household income for the city. And rather than relying on the manager's office and the city councilors trying to find our minutes that said that, we produced this memo, and I thought you ought to have it for your records. Okay, so the next item, which is number 6, again, this has been withdrawn. We were advised of this on Monday that the check isn't ready to come to us from the treasury yet, I guess. I suspect this will be at our
We
next.
had one piece of information that was missing, and so they didn't get it in time, so it was withdrawn. So it will come through next month.
This is the, under that 5-year.
Right, the CIP money.
CIP, the city deposits $25,000
Correct.
per year into the general public arts.
Well, and my understanding is it's in the budget and under the CIP, that once the budget's approved, that money's available.
That is correct. And that's not the problem. It was a procedural issue, and something was not, we didn't get a piece of the procedural piece in
Okay.
time. So it has nothing to do with the funds, and I'm sure that they'll straighten it out, and it'll probably come through next month.
Okay.
Yeah, the money's there, so.
Yeah, it's there.
Okay, so the next item, number 7 on our agenda, it also relates to the Public Art Trust. And so in your packet are some templates that Jen Smith and I worked on. And just background on this is that you recall that we had a few instances over the last 6 or 8 months where we had requests for disbursements that either didn't have the necessary certification of a council vote allowing and directing us to make the disbursements, or had a council vote that might have approved the project, the art-related project, but didn't approve the disbursements from the monies that we were holding for it. So Jen approached me, and we discussed trying to come up with something. And so I worked with her in preparing these drafts. So you'll see that the first one, which relates to the city council resolutions, is drafted in the alternative. The first one is a proposed standardized resolution that would have the council authorize entering into the contract that would cause the piece of art to be created and installed. And then the second would be directing us to release funds from the source that was going to cover that. And then the second page is the alternative, which is at a point where the art contract was created in an earlier date, and we had at least one of those this year dealing with that. And so it was only necessary to direct us to disperse funds and to pay for the artist as the work was created. In each case, the language incorporates the language that we worked with the legal department on, allowing for the city manager to make multiple disbursements on a contract without having to come back with a separate vote every time the contract called for an interim payment. And then we added in the footnotes as sort of instructions to whoever's going to prepare this. And one of the things that appears to have been the case over the last year or so is there have been changing personalities that weren't necessarily aware of how these things were done. So, well, and then I should say the second set of two resolutions deal just with the park committee, and they are intended to cover the incident that came up last month where there are funds remaining from a project that was dedicated to a particular piece of art. Those funds are no longer necessary because the project has been fully paid for, and under the ordinance, those funds are to be placed in a general art maintenance and other art purposes category. We actually voted on that at our last meeting for the wastewater treatment plant. But the park, somebody has to certify that to us, and Parks the people, because they have the oversight on these projects. And so the suggestion was that in order to have a clear direction from them, we create these alternative resolutions as well. And so, Jen has had these approved, or the format of them approved by both Park and by Sean Clancy, who is the staff liaison. And so if they meet with our approval, presumably they will now we'll have a standardized set of resolutions that should avoid all the where's our resolution language at the last minute.
I move that we approve the templates as presented to be executed when the requests are made.
Okay, is there a second to that?
Second,
Any questions about the templates?
I do. So going forward, this is what will be used, you think? Yeah.
That's the intent. That's the whole purpose for the exercise. All right, any other questions about the content or the procedure that got us here? Hearing none, then I'll call the question. All in favor, indicate by saying aye.
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 And the chair votes aye.
Did Chris second
Chairman.
it? Did you second it? Okay, sorry.
Thank you.
While we're on this, I have an item I want to bring up before we get to TD. And I would just like to say that we had requested a report from the legal department in regards to the TD Bank change, which we never received in a timely manner. We did finally get it. And my suggestion would be, and I'm happy to, when they come, that we execute on, if it's okay, if the content is okay with us, we execute it and Judy will forward it to them for their signature, so we don't lose another month or so of this.
Actually, I had anticipated that Jen would be here today to walk us through any questions, but well, let's talk about that. So my expectation, TD has not seen this draft yet
Right.
because I didn't want to send it to them for their review until
At least
all of us.
until we had gotten it.
Yeah, yes, exactly. And based on the process that occurred back in 2021, you know, they're not going to review it and say, yes, we'll sign it. So that's one of the reasons that there's language in there that says that whenever it's signed, it will be effective on July 1st, right? Which would have been 2 days after or 1 day after
So
we
it's
received.
retroactive.
Well, what we could say is we're forwarding our draft of the agreement, and we can sign it if it's okay with us. And then when they send it back, we'll be done. I don't wanna have to keep going through meeting after meeting.
Yeah, no, so the only thought I would have is, I'd be okay with us signing it and then just having Judy hold the signed version.
Sign
Instead of
pages.
sending the signed version, have that get lost somewhere.
Yeah.
Or some little change tried. And so I just don't want something floating out there that gets changed and then has signatures on it.
Yeah. You can hold an escrow, Judy, our signatures.
Okay.
Questions about?
What if they change something though?
Well,
If they change something, it's gotta come back.
Okay,
And
okay,
when we send this to them, I think we just say that they should contact Jen directly and
okay.
hammer it out
Yeah.
instead of coming to me and then I sending it to her,
Yeah.
so.
So basically, if you all approve, you're gonna sign what we have today. I'm just gonna hold it in a safe place. I'll put it in a
Yes.
safe upstairs and we'll just hold it until
Oh,
we're
but
sure.
then, but then, after the meeting,
Yes,
we will send them the draft
the draft unsigned.
unsigned.
Yes, yeah, I understand.
And they're gonna be here live today, right?
Yes, well, no,
Oh, Zoom, okay.
Zoom. Yeah, they couldn't make it, so, but they said they could do it by,
Okay,
Teams.
all right.
Yeah.
All right, so, well, you have an unsigned version now too, right? Because that got sent around on,
Was that the one that you sent?
that's the one that I forwarded Jen's email to.
Amendment to agreement for financial advisory?
Yep, that's it.
I do have it.
All right, so we'll actually, so let's deal with that. 8, 9 minutes we got before they come in. Were there any questions about this draft that you received?
No, as long as the retroactive to July 1st, so we don't lose anything.
Okay.
And I think that, I intend to thank them today for their consideration and reduction of the fee, and Judy will be sending them a proposed modification.
We should be thanking you as well for keeping dogging on and pushing, so thank you, yeah.
Hey, Credit is
it's gonna
given
save
where
us some
credit-
money.
Yeah, absolutely.
so let me just add on an overview because what Jen was attempting to accomplish in this was, and for Chris's benefit, because you weren't here in 2021. So when we first went through the choosing a new fund manager and advisor, we ultimately, we negotiated the rate and stuff like that, and then it came time to memorializing that, and TD presented us with some very standardized documents that they use for the whole client base of their private client wealth customers, so to speak. And we had some concern because, as you know, we're subject to certain statutory regulations on the type of investments that we're permitted to use. We have a policy, which we've had one at least since 2011 when I first came on, that we reworked in 2022, and that we were concerned there might be some conflicts in that language. So we had turned it over to the then city attorney, Bob Sullivan. He ended up negotiating what I'll call an override document, which incorporated all the CD, all the TD managements for our 4 funds, plus TD's response to the original RFP, and essentially created a unified document of all those components, and then had certain hierarchies in it saying that the document that Bob had prepared would override any of the standardized TD documents that were in conflict. And So when TD came back and actually said, we're willing to reduce our management fee, I was hoping we could have a one-sentence document which would say, you know,
Reducing our management.
we're reducing the management fee, everything else stays the same. But, you know, as it turns out, that's just not the way they do business. And so this was an attempt to, this document that's in your packet was an attempt to sort of amend the document prepared by Bob to reflect the new 2026 documents from TD, and also to more fully incorporate our investment policy that wasn't adequately addressed in our 2021 because it really wasn't updated until 2022, a year after we became officially became customers, so to speak. And so what this tries to do is say we're agreeing to reduce the rate because the original documents from 2021 did not actually list the particular investment vehicles that were going to be employed, whereas in 2026 there have been, and there's an ongoing set of investment vehicles for each of these funds. Those have now been acknowledged as our current state of affairs, and then none of the prioritization or rules on priority and conflicts between documents are changed. That's what the intent of this is. So we anticipate that my expectation, my opinion after reviewing the documents we received last month from TD is that they're updated versions of documents that they've had that in many cases give them more discretion than what we allow for under our policy. We have much more reporting requirements in terms of, you know, what TD can and can do without having to come and get our prior approval. And we wanted to retain those to be consistent with what we negotiated with them 5 years ago. Does that make sense?
It does. So, question please. Is that a state statute or is that a Portsmouth mandate, if you will?
It's both. So
Does that make sense? Does that make sense? My question makes sense?
Yeah. Well, so what happens is we have an investment policy.
Be Portsmouth.
City of Portsmouth,
Yeah.
trustees of trust fund.
Yeah.
This isn't the city's investment
Okay.
policy.
Okay.
This is
It's even more. Okay.
Yeah, I mean, and it was specifically drafted to incorporate the conditions that state statutes place on trustees in what type of investments you can make. And, you know, we've talked at other times about taxpayer expendable funds versus private donations and how there's much more restrictive avenues open for investments for taxpayer expendable funds. And none of that stuff is part of the TD investment options. And so because it's part of our investment policy, we want to make sure, and this was true 5 years ago, that TD is not going to put us into an investment that would be contrary to our policy and therefore also potentially contrary. And yeah.
I think
That's helpful.
one of the
Thank you.
things,
Very helpful.
Chris, that Attorney Sullivan was able to accomplish is to simplify, and which TD finally agreed to incorporate what we needed and what they needed. And it made it a document, so, and it was approved 5 years ago. Let's just hope that they will.
Yeah, I can't imagine, because we're not asking, you know, when we asked for a change in the management fee, we weren't inviting a negotiation of our entire relationship, I guess.
Right.
But, so then I guess the question would be.
Background's helpful, so thank you for going through that.
Oh, absolutely.
Yeah.
And I'm glad you asked. So I'm sure you've reviewed this. If you think that this is adequate for the purposes that I just described, then I would entertain a motion to approve this as a proposed additional document for our new relationship with TD.
So move.
Second.
Okay, any further discussion on that? All right, hearing none, I will call the question. All in favor indicate by saying aye,
Aye.
Aye.
and the chair votes aye. Okay,
Thank you both for your history and your knowledge and your shepherding this. I mean, some of this stuff is really complex.
Well, it's,
You almost have to be an attorney, Tom, to,
Hi, John.
you get to read it 3 or 4 times for it to really
yeah, you,
sink in, and then you have more questions than you did when you started reading it.
morning, John.
morning, John.
Morning, good morning.
Good morning, Peter. Good morning, Tom. How's everybody?
Good.
Great.
Things are well.
John,
Is my audio coming through okay?
it is, and Kevin's going to make it so that you can share the screen. So hang on one
Oh,
second.
terrific. Thank you. I'm all set to do that. Just populated on my screen, so I think it'll work. Shall I try to do that now?
If
Kevin,
you want.
ready?
Is
Yeah.
Suzanne gonna be joining us this morning?
Okay. I do expect Suzanne to join. Yep. She can certainly catch up in progress, so up to you unless there's anything you wanted to discuss before I jump in.
No, we'll go with your presentation, and then we have some comments about the management, the change in management fee and that type of thing that we'll share with you at the end.
Okay, sounds great. Let me try to share here. And can you please let me know if you see the page with the pie chart?
Do.
Yes.
Okay, terrific. So I'm going to walk you through 2 decks, the usual investment overview, and then I've got a second quarter market update as well, similar to prior meetings. And I'll remind you, I'm showing the scholarship fund on this first page. All 4 portfolios are identically managed to the same model, so all the comments that I make on the scholarship pages apply to all 4 of the accounts. You can see at the end of June, end of Q2, the scholarship fund was just under 16.5 million. Quarter to date, you're up a couple of percent from that, so it's been a reasonably good start to the third quarter as well. On the asset allocation side, let me scroll over here. I'll remind you the overall portfolio asset allocation is 75% equities, 25% fixed income and cash. And the way this pie chart works is it's color coded, so shades of blue and purple are equities. Obviously, you can see that's just about 75%. And then it gives you greater stratifications by style and geography, which are a little easier to see in the table to the right. Your largest holding remains what we call large cap core in our nomenclature. Think of that as the S&P 500. That's about a 52% weighting in the model. Your IPS has a 50% target, so we're slightly overweight the S&P 500. Below that, you see a roughly 7% allocation to U.S. large cap value dividend style stocks. Your IPS has actually no stated target for any specific styles of U.S. large cap. You can really, this is a bit of a tactical overweight within the portfolio. We've held this for a while. You can really think of it, this is probably the biggest deviation from your investment policy. The policy has a 5% target for REITs, which are real estate investment trusts. And this is really a substitute for that. And what's nice about this as a substitute for REITs is you typically want to be in REITs for the income. You know, it's not uncommon for either trust clients or in your case, trustee or trust fund clients to have certain accounts that you can only spend the income from, and REITs by definition, in order to obtain their tax status, have to pay out 90% of their dividends to investors. Within the large value dividend segment of the U.S. stock market, obviously companies can choose to pay or not pay dividends. what you tend to get in this segment versus REITs is better long-term growth, and we've seen that. So it's not a big style difference from your IPS, but on paper it does certainly look like about a 7% difference. Mid-cap is equally weighted with your investment policy at 5%. International, you can see we've got a 10% allocation to developed international markets and just under a 2% allocation to emerging markets. We added the emerging market exposure at the very beginning of 2026. And that was a good addition to the overall portfolio. We actually took it away from large value dividend. This is another slight deviation from your investment policy. You have a target 5% weighting, so we're about 3% underweight EM. Other than that, the overall construction of the portfolio is very well aligned with your IPS. There's no major tactical differences, the biggest one being REITs, which we discussed. And then below that, you see fixed income. So other fixed income is this 2% allocation is high yield. We have decreased this over the last year to the 2% that you see here. You don't have any allocation to high yield as a stated target within your IPS. And then on the fixed income side, everything else is investment grade, and it's primarily U.S. government securities, complemented by U.S. investment grade U.S. corporate bonds. So overall, your bond portfolio has a duration of about 5. You can think of that as your average maturity. So it's a 1 to 10 year portfolio, similar to most intermediate bond strategies. You have an average credit rating of single A, so an investment grade average credit rating. Your mix between U.S. government bonds and corporate bonds is about 65-35, so predominantly U.S. government bonds. And the yield is about 4.2%, which, if I go back to when we built the portfolio back in 2021, where you couldn't find rates above 1%, we've come a long way since then, which is great. And then interestingly, I'll show you a chart on this later. Rates have surprised to the upside this year, which has a negative impact on fixed income performance, but a positive impact on any reinvested cash flow, so a bit of a double-edged sword. If I move over to the left here, I just want to show you, and I'm going to go to performance in a couple pages, but for the quarter, so for the second quarter, the portfolio was up just under 10.5% net of fees. That is in contrast to being down almost 2% in Q1. So huge rebound in Q2. The first quarter was characterized by the initiation of the war with Iran, massive increase in energy prices, the ensuing inflation that came from that flowing through, and a big kind of just a risk-off mood in Q1, which led to a pretty significant sell-off in tech stocks. We saw the exact opposite in Q2. So energy prices came down considerably, hopes for the war ending, were stronger a couple months ago than they are right now, but nonetheless, big change in sentiment. And then tech had a huge reversal to the upside, and I'll show you some of the detail on that when we get to the market update. But big rebound in the second quarter. And then I'll touch on these other figures in a couple of pages. And then just lastly on this page, your yield of 2.07%. So that is comprised of both the dividends that you're receiving on your stocks. Your equities are yielding you just under 1.4%. That's a little bit higher than the S&P 500 as a whole. That's because of the allocation to the dividend stocks that you have. And then again, on the fixed income side, you're earning about 4.2%. So it averages out to just over 2%. With that, let me turn you to, I don't think I mentioned this yet, the model, the portfolio model for all 4 accounts. Let's see if we can get this above that. Let's see. All right, that's about as good as I can get it. So this is your portfolio model. If I just focus you on the far left-hand column, each row in this report is a holding in your portfolio. And I'll remind you, all of your holdings are what we call passive. None of these are hiring a manager to decide if it's better to own, Microsoft or Google or Coke or Pepsi. What we're doing, and this is specific to the preferences in your investment policy, also happens to be the best performing portfolios that we've seen across all of our client portfolios for quite a while now, is just passive exposure to the underlying indices. So this top holding, the Fidelity 500 Index, is a mutual fund designed just to track the S&P 500. This is and you can see the style name in the middle column. This is your 7% allocation to the value dividend segment of the U.S. large cap market. Again, we're just trying to track the Russell 1000 value index, et cetera, down the rows. In total, you've got 11 different products here, 5 on the equity side, 6 on the fixed income side. And again, your largest exposure is to the S&P 500 within equities. Your next largest holding is developed international markets at 10%, and then back up to the 7% in large value. What I really wanted to point out to you here in the second quarter, which is what you see in this third column from the right, as I have it magnified, is really strong rebound for the S&P 500, which was down closer to 5% in the first quarter. Another strong quarter for U.S. value. It did underperform the S&P 500, but it outperformed REITs during the quarter. It outperformed developed international stocks, which were just about 8%. And I highlighted the year-to-date performance. This is a real contrast. We don't expect this to be the case in most ongoing upward markets, but year-to-date you can see, roughly 16% for the value segment versus 10% for the S&P 500. We haven't seen that level of outperformance in quite a while. Interestingly, it was Q1 of 2025 where we saw outperformance by value, just not to the same degree. So this tactical allocation has been helpful, but I really think of this more as a substitute for REITs in your portfolio than anything else, and it's served us well. The best performing holding, fortunately it's only 2% of the portfolio, was international emerging markets. You can see up almost 20% in the quarter. This is always going to be a highly volatile component within your portfolio, but it is a core long-term holding of TV's models, and it's also a core target within your investment policy. Interestingly, quarter to date, just for the roughly almost 2 months of the third quarter, it's been the worst performing segment. It's down about 3%. So you're always going to see volatility in this segment, but adding this to the portfolio earlier in the year has served us well. And then you get to the fixed income components, and you'll notice fairly modest returns for the quarter, anywhere from roughly flat to up 2%. High yield continues to be the best performing fixed income component in your portfolio. All of these returns on the fixed income side have been impacted by rising rates. You've heard me say this before. Bond prices move inversely to interest rates. So when interest rates fall, bond prices go up. When interest rates rise, bond prices fall. We've been in a rising interest rate environment. Now, the reason you don't see negative returns across all of these bond holdings is because the increase in interest rates hasn't been enough to offset the positive coupon income. Because your bonds are yielding, between 4% and 5%, depending on the type of bond, the rise in interest rates is negatively impacting pricing, but the coupon income that you're receiving has offset that. And the highest coupons are in the lowest rated segments. So the bank loan segment is below investment grade, and at the very bottom, the high yield segment is below investment grade. So those are companies, they're the least, they have the weakest credit ratings. As a result, they have to pay the highest rates. So those companies are paying interest rates, somewhere between 6 and 10%. That higher coupon tends to offset, or it has offset, the negative impact on prices from rising rates. you still have a modest allocation to high, we call it high yield. I think it's best described as below investment grade. It's been an accretive part of your portfolio. It'll always be a fairly modest allocation. That said, it is the riskiest component of your portfolio. You know, if we ever do get a meaningful recession, you will see underperformance relative to your investment grade corporate and U.S. Treasury holdings. And then just lastly, on fixed income, you can see in the quarter your weakest performance was actually from an allocation to all U.S. Treasury bonds. You can see it's by maturity. So this 3 to 7 year U.S. government bond ETF, the reason it was the worst performing is because that part of the yield curve saw rates rise the most. And I'll show you that on a graph when we get to the market update. And then just lastly in this deck, just a more high-level view of performance. Here we go. So again, for Q2, really strong quarter. Your performance is this middle column, TWRR, which stands for time-weighted rate of return. These are net of fees. I like to compare these to the asset allocation in your investment policy. Again, no real big tactical differences from your investment policy, which begs the question, why in Q2 did we see about a 1% underperformance versus your IPS? This was a really interesting quarter. The reason for this is tracking error between the holdings and the indices. So let me explain that. Within emerging markets, you have a exchange-traded fund designed to track the emerging market index. As I showed you on the previous page, your holding was up 19% for the quarter, which is great, but the index was up 24%. So almost a 5% difference in the ETF holding versus the index. Similarly, in the developed Europe ETF, it was about 150 basis points below the actual index performance for the quarter. So the reason for this is, and you don't see this level of divergence very often, but it's called tracking error. It occurs primarily for two reasons. One, timing differences between when international markets close and when U.S. markets close, which is obviously you're invested in U.S. dollar markets. And then secondly, the composition of the benchmarks will change, and the products obviously have to align to those benchmarks. And when it occurs in highly volatile quarters, and in this case, highly volatile increasing return quarters, you can just tend to see these variances. They tend to even out over time. But of course, your investment policy isn't actually invested in any products. It's just, weightings to the indices. So nothing here to give me concern, nothing due to any tactical allocation bets one way or the other, just tracking error within the products. And like I said, I would fully expect to see that even out over time. I looked at the Q3 numbers quarter to date, and about half of that has been reversed, so not surprising. In Q1, just as a reminder, it was a down quarter. We did slightly outperform your policy benchmark in the first quarter. That was based pretty much exclusively on that overweight to the dividend value stocks. And then just going down to, since inception, just north of 9% total return for your portfolio and just under 9% for the IPS. And currently, not recommending any tactical changes to the portfolio. I manage your portfolio specific to your investment policy, but I always want to be aware of kind of TD's own, tactical views within our models. I will always recommend changes or implement changes where it's consistent with your IPS and also consistent with the firm's views. Right now, there's absolutely no need to change the portfolio. I think you're well positioned for the current environment, and it's also consistent with TD's views, and I'll show you that in a few pages in the next deck. That was all my prepared comments for the specific investment policy deck. Are there any questions I can answer for you on these pages?
Please, yes, if I could. Hi,
Yes.
John. Hi, John. It's Chris Clement.
Hey, Chris.
Yeah, thank you.
You too.
I always learn so much from these, so I'm grateful for that. My question is probably a simple one as it relates to the international new emerging. We're at 2.04. How do you know to go higher or lower? I know we took it from the larger fund, and we created that last year, which was great based on, I think, the first part of the year. I think some of it's been reversed, you said. How do you know? Is that an algorithm, or is that gut? Is that experience?
Yeah, so it's as much art as it is science.
Okay.
I could match all of your holdings to your IPS and, kind of guarantee that you're going to underperform your IPS targets for one simple reason, which is the indices themselves don't have any fees associated with them, but your portfolio is obviously subject to management fees. It's not a lot, it's only 20 basis points, but nonetheless, I don't want to construct a portfolio for you that is going to subject you to wild swings relative to your investment policy. I do like the idea of incorporating tactical adjustments where we can hopefully add value. And you can see that, interestingly, I'll show you, I'm just going to go back to the page I was just at. If you look at since inception, your portfolio return net of fees is roughly 23 basis points higher than your investment policy. That makes me happy, where we've added value above your fees compared to just matching the IPS. The reason, and when we've given up, as you can see year to date here, we've given up almost 1%. So this year, going back to the fourth quarter of last year and then into this year, we've given up some of that gain. We were underweight international. And that was the main reason we were underweight international relative to your IPS targets. That was the main reason for the outperformance. And then when it really goes back to the second quarter of last year, if you remember the chaos associated with the announcement of all the tariffs, that led to a significant depreciation, like a 10% depreciation in the US dollar. And that was where we gave up some of that tactical advantage. I've reduced the odds of that going into this year, hence the addition to the international market. So these are kind of the bets that we're playing within the portfolio. My hope is to, over the life of our relationship, be able to maintain an outperformance to your policy targets. It's not easy, but it's always going to be done with a fair amount of subtlety, because in no way do I want to expose you to massive underperformance relative to the overall markets. But I do think there's value to trying to incorporate TD's tactical thinking where it's a fit for your IPS. It's possible, although unlikely, that someday I may come to you and say, TD's got a really strong view on this segment of the market, but it's inconsistent with your IPS. Let's think about, changing that language. But considering how your IPS is currently constructed, I don't expect us to have that conversation anytime soon. Chris, does that make sense?
Yes, it does. Thank you. Very thorough response. Appreciate that, John.
You're so welcome. Anything else before I walk you through the market update?
Actually, John, I thought you were going to answer that question by saying you had this special sauce and didn't reveal it to any of us.
It was all gut instinct. That's what I was hoping for.
Before we go on to the market update, my question, as the usual one, is follows up from your last comment, which is, do you see any, do you have any recommendations that we make changes to our investment policy at this time? Or it sounds like, based on your last comment, you see it as appropriate, but just want to make sure we don't pass an opportunity to get your opinion on.
Thank you, Tom. Yeah.
Yeah, no, I'm always cognizant of the construction of your current portfolio and what we're trying to do in incorporating TD's views with what the policy, while staying on side with your policy. I think your target allocations are appropriate. You are allowing for exposure to all segments of the market, which allows me to diversify the portfolio, which is very important from my perspective. I don't feel constrained in terms of, I would let you know if there ever was something we wanted to do that was inconsistent with the policy. You've got stated benchmarks, you've got, I think, appropriate targets to various sectors in the market and asset classes. And it's constantly being reviewed, so no, not recommending any changes at all.
Great.
One comment before we go to the market review for
Please.
Q2. Thank you very much for your proposed change in the fee schedule.
Oh, yeah.
We appreciate that. Judy will be sending you a response to what you sent to us. The only thing I'd like to say is, in our response, we want to make sure this is effective July 1st of 2026.
Now or August.
We've been going over this for we made a request before, you didn't get back to us. So let's.
Yeah, so all I can do, please send me the paperwork back, because until I have that, I can't implement the change.
Okay.
And then all I can do at that point, so when I implement that change, what's gonna happen automatically is, I think what the system will automatically do is calculate, because you paid the third quarter fees in July. I think what will happen, if I implemented it today, I think what the system would do once it processed is it would automatically rebate the difference
Right.
going forward for the quarter.
Yeah, okay.
And so, as to what I actually don't know what I would have to do to honor that request, but I will gladly pursue it.
Okay, well, Judy will send that out to you today.
I just want to be clear though, John, what I'm sending you is not what you sent me. I don't know if you're expecting to see the documents that you sent signed. They've got another set of documents that I'm sending you.
Let me jump in on this, John.
Thank you, John.
I was gonna do this after listening to your market review, but since we've opened this door. So you recall that when we originally entered into our agreements with you in 2021, that you presented us with, I'll call it a standardized TD client agreement, management agreement, and for each of the four funds, and that our then city attorney Bob Sullivan worked with you and your legal department in creating not a standard document, but a specifically created document that would mesh those four TD documents with our investment policy and certain requirements for pre-approval for us that limit probably the traditional discretionary authority you have for most clients. Do you recall that process?
I definitely recall the process.
Okay, all right. I'm hoping this one will be a little quicker, but so what we asked Jen Smith, who's an assistant city attorney and who works with us now, I think you saw her at one of your earlier presentations a couple of months ago, is to look at what might be necessary to keep the new documents part of the package that was governed by that document. And so what you're going to receive is about a 2.5 page amendment to the 2021 agreement that was created by Attorney Sullivan. And again, it's not I can best summarize it by saying is the intent is to recognize the change in the fee without a change in the rest of our relationship. And
Are you under the impression that signing the fee schedule update that I sent to Judy would otherwise affect the existing relationship?
well, that was our concern.
Yeah, because that document, it simply states the investment model and the fee schedule. It doesn't even reference,
Agreement.
it does make some kind of boilerplate reference to TD's overall program, but it doesn't have any impact or reference to the original account documents. So the short answer is I don't know, in the absence of, I think a similar document must have been signed at inception, because I don't know how we would have gotten the original fee schedule even implemented without it.
Well, yeah.
I will look into that.
If you can't find them for some reason, or let us know, because I have those documents.
Yeah, let me actually just really quickly, just if you can just bear with me, let
Sure,
me see.
Absolutely.
I may be able to pull it up.
So
Where's the system?
while you're doing that, so part of our concern in reviewing the two documents that you sent along early July is it may change things dealing with affiliated investments and things of that nature that were different than what existed in your 2021 documents. And so, again, our goal was to keep the relationship the same.
Yeah, so here, can you see these signatures?
Yep.
Yep, so this, let me just scroll to the top. This is the document going back to 2021, which is identical. It's the exact same document that I just sent for the fee update. So what I sent you, and here are the signatures, you signed this exact document at inception, which I figured had to be the case because it's the only way I can get fee schedules updated. So it's identical except for the fee schedule, and it probably reflects, it puts the investment model in there as well. And so it would reflect your current investment model versus where we started 5 years ago, which is changed slightly, but that's, it's your current investment model, so obviously no issues there.
Okay, well, so the document that you're showing on the screen appears different than the versions that I have, which...
the versions that you have from, you mean the original docs?
From the 2021, yeah. Just to...
Let me go to the, I just went back to the first page for you. You don't have this document anywhere?
No, what I have is, I don't know, you probably can't see this, but it doesn't have a cover sheet like that with the big green TD on it. And the document itself is, each page is 2 columns of text.
Well, this is just one document of many that were part of the original package. But I guess my point is, what I sent you to implement the pricing update is identical to what you signed originally when we put the original fee schedule in place. This was the original investment model. And then fees, let me go to fees here. And so I'm sure this is a little confusing to see, but let me, what you can see here, it lists all 4 separate portfolios, Prescott Endowment Scholarship, but you can see the all-in fee of 20 basis points. So, I mean, this really is the fee schedule document that the trustees signed, and so can you think of a reason why you wouldn't want to similarly sign just an update to this document in order to implement the fee schedule change?
Well, look, let me just-
Or would it help if I sent you this document?
Well, yeah, so let me suggest this so we don't keep you trying to do this on the screen where we can't read the writing. We'll send you this thing that Jen prepared, just so you'll have it and a chance to start looking at it. But if you could send the 2021 versions of what you gave us back in early July, we'll do a comparison. Obviously, we're looking at least the documents I have, and it may be that our legal office has additional documents, but we are looking to keep the relationship the same, and so I'd venture to say that if the documents that the 2 agreements that you presented us a month and a half ago are identical to what we signed in 2021, then we're not going to have a problem signing them again. So let's do this such that if you could send us that document for each of the 4 funds, or what? Oh, I don't know if you broke those up into.
It's all in one document.
Okay, and we'll send you the agreement that Jen prepared. We'll take a look at those, and we'll have her get back to you to try to sort this out, because we'd like to resolve it and get the arrangement, working immediately.
Yep. I've got, as soon as we're done, I've got the email ready to go to send to Judy. And I just downloaded this. So yeah, I think once you see this document and you're able to compare the 2, hopefully it'll be straightforward for you.
Okay, no,
Great.
that would be great. It may save us some further time and effort.
Sounds good. All right, let me figure out how to get rid of this. Okay. Excellent.
Any other questions?
Not for me.
Okay,
Thank you.
that's great. So
Okay.
you want to go to the market review? That would be good.
Yeah, and I'll go through this quickly. We've covered most of these points. There's just a couple things I wanted to point out to you if you haven't had a chance to see it. Page 3 that just goes over asset class returns at kind of an index level, consistent with what we just went over, for the quarter, bonds, modest returns because of the impact of rising rates. If you look out over the 3-year column, this should be pretty consistent what you see going forward, over the next few years. Your yield is in the 4% range, rates have risen, that means all of your reinvested cash flows get reinvested at higher rates. So we currently live in a 4 to 5% interest rate world, and so, on a 3-ish year basis where the impact of interest rate movements becomes less of an effect, you should see, kind of low to mid single digit returns like you see in the 3-year column here. But short term, you're always going to be impacted by rising and falling rates. And then on the equity side, as we discussed, strong, second quarter performance for all indices, emerging markets, you can see 24% did really well. What I highlighted here year to date was just the dramatic difference in large cap growth at 5% versus 16% for the value dividend style segment. That's a big change from what we've really seen over the past 15 years. And in Q2, if you just go one column to the left, you can see growth did outperform value. Both were up significantly. But because technology is now over 30% of the S&P 500, investors' preference or lack thereof for tech stocks is always going to drive big valuation changes for the growth style segment of the market. This is a perfect illustration of that. Let me just make this a little easier to see. I've shown you this chart before, so on the left side, you see all the sectors that we use to divide up the U.S. economy. So technology is on top, the S&P 500 in aggregate is the second one, and then you see industrials, consumer discretionary, financials, etc., all the way down to energy. Blue was the first quarter of 2026. Green is the second quarter. If you just focus on the top and bottom rows, energy up, almost 40% in the first quarter, down 14% in the second, and technology almost just the opposite, down almost 10% in the first quarter and up over 30% in the second. So these are the type of swings that are really driving the S&P 500 these days. And again, tech is over a 30% weighting. Big rebound in Q2. What we as a shop like to point out on this chart is in the second quarter, absent energy, broad participation across all the sectors. This is a sign of a healthy stock market, right, where all sectors are benefiting from economic growth. And we saw that in Q2, and we've largely seen it so far for the first 2 months of Q3. So that's a constructive sign for the stock market. I wanted to show you interest rates. Before I get to interest rates, this is a new chart. You haven't seen this one before. And this speaks to investors' concerns over, just try to make that visible. Investors' concerns over geopolitical conflicts. So what this table does is it shows you roughly 10 conflicts going back to 1990. So we're covering decades of geopolitical turmoil here. It starts with Iraq invading Kuwait back in August of 1990, down to the most recent war with Iran. And what it's showing you is stock market performance after 3 different periods, 1 week, 3 months, and 3 years, with the pinkish hues being down markets. And what you'll notice is as time goes by, equity markets tend to get back to focusing on fundamentals and less about short-term risk, such that when you get to the table at the bottom, on average across all of these military events, stocks were up almost 30% within 3 years of the start of the conflict. And interestingly, this number would be significantly higher if it weren't for the minus 28% that you see going back to a conflict that I'm guessing most of us don't recall with much detail, the Second Chechen War. And what's interesting about that is just the timing of it starting in August 99. It obviously just preceded the tech bubble collapse in 2000. So that's kind of an interesting outlier. But nonetheless, the point here remains that TD's advice consistently tends to be, and this would certainly apply for trustee trust fund accounts where you have a very long-term time horizon, staying the course with our investment discipline tends to be the best action over time. And that markets over the long term get back to focusing on earnings and growth rather than the volatility that comes with the uncertainty of war. So I thought that was a chart worth highlighting for you. And then secondly, we spent a lot of time in this call just talking about fixed income and the impact of rates on bond portfolios. So what you see here is a graph of U.S. Treasury yields. 1-month Treasuries on the far left, 30-year Treasuries on the far right. The blue line was where we were at the end of the first quarter. I'm sorry, the green line is where we were at the end of the first quarter. The blue line is where we were at the end of the second quarter. You can see a meaningful increase in rates, 30 basis points for the 2-year, 10 basis points for the 10-year. You may remember me pointing out to you that it was your 3 to 7 year U.S. Treasury portfolio product that had the worst performance, and it was basically flat for Q2. That is precisely because of this increase in interest rates. You can see just by the gap between these two lines that the biggest increase in rates was kind of in the 1 to 7 year part of the curve. This is a real surprise. You've heard me say this before, but it's worth repeating, to outsmart the fixed income markets, you have to get three things right. You have to get the direction of rates right, you have to get the magnitude of the change right, and you have to get the timing right. And I've been staring at screens of interest rates for over 30 years. It's pretty much impossible to get one of those things right, let alone all three. This year is a textbook example. We went into this year with all the Wall Street firms expecting 2 cuts in the Fed funds rate from 3.75 to 3.25. Now there's currently like a 30% probability of a Fed increase priced into the third or fourth quarter. TD is not in that camp. I'm going to show you our interest rate forecast here at the end. But just a perfect example of just the uncertainty of interest rates. The other thing I'll point out here is, we talk about the yield curve, that's the title of this chart. Literally, we're referring to the curve that is created when you plot out all these interest rates. Well, what I particularly like about where interest rates are now is we have a meaningfully positively sloped curve. This is what you would historically think of as normal. Investors should get compensated more for taking on 10 years worth of interest rate risk with a 10-year treasury versus a 1 month, right? Borrowers should expect to pay more if they want to lock in an interest rate for a longer period of time. Our whole kind of financial system is largely based on a positively sloped yield curve. We had not been in this environment meaningfully since the early 2000s. When we had the financial crisis in the mid to late 2000s and the Fed responded with ultra low interest rates, we ended up with a pretty flat yield curve. And that pretty much held all the way through into 2022 when the Fed engineered a dramatic increase. They only control the Fed funds rate, which is the overnight rate, so way over here. They took it up to 5.5% before cutting it to 3.75. But when they took the short end all the way up to north of 5%, the rest of the yield, we had a negatively sloping yield curve. So this is a much healthier interest rate environment. While rising rates does have a negative impact on bond portfolio prices, it sets you up for much better fixed income returns going forward. And if you think of, inflation's been higher than the Fed target. In fact, let me jump to that right now. CPI is the bottom row here, and so this is the 4 quarters of 2026 and then forecast for 2027. 3 to 4%, nearly twice the Fed's target of 2%. Even at 3%, in a world where you can earn close to 5% on investment-grade corporate bonds and north of 4% on U.S. Treasuries, you're still earning a positive real return. And as you go across this bottom row, we do expect inflation once we get past these geopolitical conflicts to see energy prices come down, which is really what's been driving this increase in inflation. And we think it'll take until the second quarter of 2027 to get back to the Fed's target, but that's our forecast. So in this interest rate environment, if inflation's back to 2% and you're earning north of 4% on risk-free government bonds, that 2% real return is about as good as I think we're ever going to expect. So this is a good interest rate environment for fixed income investors. I realize it's only 25% of your portfolio, but it'll also act as a meaningful stabilizer if we do get periodic corrections in the stock market. So just focusing on this top row here, this is our forecast for Fed fund rates. We had 50 basis points of cuts baked into this year, which we have simply pushed out to next year. And we think that'll be based solely on inflation coming back closer to the Fed's target. We remain constructive on the overall economy. You can see our real GDP forecasts, third row from the bottom on the far right, 2.2% for both 2026 and 2027. We expect double-digit earnings increases for the S&P 500 both this year and in 2027. Admittedly, much of that is being driven by technology and the unbelievable capital expenditures going into data centers and artificial intelligence investments. That's definitely getting us to double-digit returns as opposed to what would be closer to high to mid single digit returns, but there appears to be no stopping that momentum right now. So kind of coming back to where we ended the investment deck, not recommending any changes. Your portfolio remains well positioned to kind of take advantage of the forecast that we see here. And again, given your very long time horizon, you absolutely have the ability to kind of withstand correction. So you remain very well positioned.
Great.
One
Those
question,
are all my comments. Happy to answer any additional questions you might have.
what is TD's feeling on when the war in Iran will be over?
Well, the short answer is we do not have a specific forecast on that. We remain as hopeful as kind of everybody else. Obviously, the ceasefire and its ensuing negotiations have not been going as planned. Although we do not see a meaningful return to kind of the kinetic warfare component and all the bombing that we saw on kind of the U.S. offensive early in the conflict. But I'm sorry, we don't have a specific date in mind.
All right.
That's a tough one.
This has been great, John. I hate to cut you off, but we have a hard stop at 9 o'clock with another group coming in, but
Always my pleasure to see and present to you all. Thank you for the dialogue as always. I will send an email to Judy within 2 minutes with the document that we discussed, and we'll get this implemented as soon as we can for you. So once you see that, just please let me know if you have any questions.
okay, and she'll send you the document.
I will, John.
Sounds good. Thank you all.
Thank you, John.
Thanks, John.
Yeah, bye-bye.
Okay, well, Judy's doing that. Let's look at our calendars and pick our meetings for the rest of the year. And staying with our third Wednesday preference, that would be September 16th. Does that work?
Works for me.
Okay. And then in October,
21st?
except for, I think.
Can't do that week.
Oh, you said that's right.
That's blocked out. So I think we're looking at
Either the
the
14th.
14th. 14th work?
Works for me.
Yes.
Okay.
Excellent.
November 18th?
Yep.
That's good for you, Peter? Good for
Yes.
you?
Yes.
Okay. And then December 16th.
Yes.
That'll be right before I get done.
Well, let's try to do January, because is that gonna be a problem, Judy?
Yes, I can't work in January, so
Can't work at all.
I have 30 days from my retirement date that I'm unable to, so I can't work the month of January.
Now, will there be somebody to cover that for
I
John?
don't know, so can we come back and revisit this, and I'll have an answer for you at the next meeting, and we can and set it
Okay.
up. But I need to talk with Nathan about how we're gonna handle that.
So
Yeah.
when are you retiring?
December 18th.
All right, so you could,
New Hampshire retirement goes by the end of the month.
oh, they do?
Yeah.
Yeah.
Okay, so you couldn't do the 27th? Okay.
So we could, if Nathan can come up with just somebody who can, you know,
Talk to him. Yep.
yeah. I mean, we don't need the same analysis, but, send out the documents. And obviously, the big things like the scholarships and stuff we normally do in January, we'll put off to February.
For February anyways, which we did in February this year. The one thing that I wanna make sure we do is the CDs.
Yeah, that's what I was gonna ask.
Excellent. So we have one that's going to roll on September 4th. According to all the banks, the best performing one at 6 months is where it's at 3.85. So I would tend to recommend that we roll it and let it roll there for 6 months, but that's up to you.
So moved.
Any further discussion on that?
No.
I'll call the question. All in favor, indicate by saying aye,
Aye.
Aye.
and the chair votes aye.
Great, thank you.
All right, I don't think we need any discussion, but I'll open it up for any questions about the TD dashboard and the other usual financial reports we get from Judy. Does anybody have any questions about those?
Not for me.
Okay,
This is to get Chris onto the bank to sign checks.
okay.
Chris, you sign here and date. Tom, you sign here as chair and then again down here. So here and here.
And dated today's date?
Yes, please.
We get the 17th.
Nathan, and Nathan has already signed. Because he's on the bank account too. And then Chris can have some of the joy of signing all these checks that we get.
All right,
The September
here.
meeting again is on,
so the meetings are September 16,
okay,
October 14,
October 14th.
November 18, December 16.
Thank you very much. And I have a lot of scholarship checks to sign.
Okay.
We'll do it quickly.
We don't have anything else on the agenda, so
No,
I would entertain a motion to, there's nobody for public comment, so I'll entertain a motion for
an adjournment.
adjournment. Do you hear a second?
Second.
All in favor?